Good evening, everyone, and thanks for joining us tonight to discuss real estate financing with hard money. So Beth and I are pretty involved in the real estate community, both online as well as in person, or at least pre-COVID, right? And hard money was always a hot topic everywhere we went. So over the years, we've written quite a few posts and blogs and articles around the subject of both investing and financing as a way to provide value. But we actually haven't met each other until a few years ago, and then we saw how we could work together collectively to provide a better lending experience for investors through our respective companies. So in the spirit of helping others to succeed, we decided to team up and create a kind of a learning series on real estate financing. So, on top of creating this opportunity for kind of everyone, all the investors to learn, we wanted to give you some tools to help kind of demystify the financing process and make it easier to get the right financing for your project and for your situation. So today's our first event in this series, and we're going to discuss how to kind of compare loan costs easily through our a tool that we built, and then just kind of a lot of the other side topics when it comes to picking and choosing hard money lenders. So with that said, let's get started. We'll share a little bit about who we are. So my name is Neely, and if you couldn't tell, I'm Vietnamese, and I'm an immigrant. I came here in 1994. I've lived in White Center, so that's kind of between West Seattle and Burien for most of my life. I have a wife and two very young kids, and I didn't list any hobbies because I'm a workaholic and because I have two very young kids. But in my past life, I liked playing tennis, bowling, board games, and just being a Seahawks fan. Professionally, I am a Husky, so a UW grad and a data nerd. I was climbing the education and corporate ladder until I found real estate, right? So I love technology. I love being a nerd. And then I found real estate. I'm like, oh man, I got to get out of this thing so I can do what I really love now, real estate, a little bit more. So I started doing flips in Seattle, and then my mindset changed to cash flow after my firstborn. And, it's hard to find cash flow here in Seattle. So I had to go out of state, and I was trying to chase the 3% rule. If you guys don't know, the 1% rule would be if it costs $100,000 to acquire a property, then the 1% rule means that you're renting for $1,000 per month. So I was trying to rent at $3,000 per month for every $100,000 purchase. It seems insane, but I found a few, and they all come with headaches, and I've had my fair share of headaches in flipping and in the BRRRR technique, but I actually decided to focus more on the financing side. So I've talked to and borrowed from a lot of different lenders because I was someone who chased rates and terms. And so I discovered kind of like a huge disconnect in what buyers wanted and what lenders desired. And so I decided to get into the industry to kind of bridge that gap, right? So I joined forces with a fintech company, a startup named Certain Lending, and they were looking to change the industry, and I had the same vision. And so I did that in 2018 and left my previous career and previous life. And that's it about me. If you want to learn more, you can just find me on Facebook, Bigger Pockets, or LinkedIn. So I want to hand it over to Beth, who's actually going to walk us through most of this presentation. And then later on, I'll walk through the end of it. So take it over, Beth.
All right, thanks, Nee. I think it's kind of funny how many similarities that Nee and I have in our background when we're putting together our profile here. Though I'm definitely not a data nerd. I like more words than I do numbers, which is ironic that I ended up in lending. But I'm also Vietnamese, if you can't tell. I actually came to the US in utero. My biological mother was pregnant with me and came over at the end of the war. And so I was born in Edmonds and raised in Issaquah. So I've been in the Pacific Northwest my whole life. And I'm also a diehard Husky fan and a UW grad as well. Although probably a little bit earlier than me was. And just like me, I'm also a former recovering IT consultant. I have no qualms about giving up that part of my life and moving full ahead into real estate. So in my somewhat non-existent personal life, I enjoy cooking with my kids, playing poker, running, and I'll challenge Nee in the future on his board games because I'm kind of a self-proclaimed Scrabble champion. So let's bring it, Nee. And I have 3 kids with Matt. Some of you probably know Matt Flynn, my husband and partner. We have 3 kids in a blended family together who are 8, 12, and 17. So that always keeps things interesting too. On the real estate side, it's always been my goal to invest in real estate While I was working in my W-2 jobs, my family raised me doing flips and hanging out at our rental rehabs when my dad wasn't busy as a woodshop teacher. So I was fortunate enough to have parents as role models early on and show me the ropes of building generational wealth through real estate. But while I learned the mechanics of flipping and landlording through them, financing wasn't really something they ever discussed. And so when I finally met Matt, and who's now my business partner and husband, as I mentioned, I actually knew nothing about hard money. And in fact, I think probably one of the first dates that we went on, he mentioned private money or hard money, and I likely went home and Googled it because I really didn't know anything about it. But fast forward, he decides to relaunch his private lending business in 2014, and Flynn Family Lending was born, and the rest is history. So that's a little bit about me. Matt and I focus on small multifamily value add properties in Washington. We don't have any properties outside of Washington. But we started out doing some flips and use that as a tool to build up our cash reserves so that we could focus more on cash flow. That's a little bit about us. So today we were just going to cover a few quick slides. We just want to make sure that everybody is on the same page. We've probably got some newbies on here, haven't really delved much into alternative financing, and probably some of you who are really experts at that maybe might even know a little bit more about it than me and I, but we just wanted to level set by talking a little bit about the key considerations as a borrower, the spectrum of hard money, because it's not really a one size fits all out there, and it's really important for you as you're looking for financing to understand the trade-offs to working with various lenders. So we'll briefly talk about changes to hard money lending and the lending industry as a whole due to COVID, because I think it's safe to say that lending guidelines have been a bit of a moving target week after week since March, and staying on top of trends and changes is important as you consider your financing options too. So after we cover these points briefly, I'll turn it over to me, and then he'll walk you through how to use the loan comparison calculator that we put together and shared out last week. And then we can help answer any questions that you guys have around how to use the tool or how to effectively compare total loan costs when you're out there doing your interviews. And on a side note, if you have any questions along the way, you can feel free to put those into chat. Me's team and my team will be on the call to help monitor that for us. And while we hope that you guys stay on mute, then we can just go ahead and answer those questions that you put in the chat along the way too. So first, we just wanted to cover at a really basic high level, what are some of the key factors that come into play when comparing lenders? There's definitely more detailed considerations, but for the sake of time on this call, we really wanted to cover off on some of the basic buckets of factors that you really need to think about and ask about when you do your review. I won't cover all of them ad nauseum because a lot of them are really self-explanatory, but the main message we want to share with you here is that there are several lenses in which you should look at your lender options. One is quantitative, and those factors are ones that directly impact the total cost of the loan, and ones that we'll talk about a little bit more in detail on this call. And then there's also qualitative factors, and those I would say really give you insight and could contribute to the indirect costs of the loan, as well as time considerations, but they're really things that you need to tease out that help you better understand what your primary goals and objectives are when seeking out lending options. So you need to really determine what your own needs are, your values, your priorities, what your circumstances are at the time, and that will help dictate who you should focus your research on when interviewing lenders. So just going from the top left to the right, first we have loan fees. It's pretty self-explanatory. Those could include origination points, other extraneous or junk fees, as sometimes they're called, including processing and admin fees, legal review. Typically, these are costs associated with a loan at closing. Most of them are upfront costs, but sometimes we've seen that points can be paid on the back end, although that's pretty rare. The next would be your interest rates, and that's something you should take into consideration. It's not just how much the interest rate is, but it's also other aspects to it. Is it Dutch? Can it be deferred? Is it prepaid? Do you have to put have interest in reserves? Some of those questions that should be considered as well as just the number itself. And then we need to consider your current cash position and how much leverage a lender is willing to take on. Basic LTV and LTC loans, so that's loan to value or loan to cost loans, are widely available, but the terms can vary greatly. And so you should be aware of what lenders are willing to do and how that fits into your plan for how much you may want to put out of pocket or how much you're able to put out of pocket. Lastly, you have broker and referral fees. And while referral fees can be typically a small fee added to the loan, broker points can really add up. I've had some brokers send loans to us in excess of 10 points. And while they definitely have their place in the world and can provide a whole lot of value in figuring out some really complex lending scenarios or difficult to lend borrowers, you really want to ask upfront if there's any broker points tacked onto that, so you can factor that into the equation as well. So across the top, all these factors directly impact your overall loan costs, which is why they are considered in the calculator that Nia and I created. On the bottom row, these are factors that contribute indirectly to the loan costs. Time to close is pretty straightforward also. While this doesn't add to your cost, it can be a major consideration if you need to close quickly, or in events where you have, such as non-refundable earnest money on the line, or maybe you have a schedule to adhere with your contractors. So asking about the time to close is something that's pretty important. Loan terms and conditions is kind of a catch-all, I would say. These affect overall loan costs, such as the length of the loan, extension fees, and what extension policies are, which vary by lender, construction or rehab holdback policies and costs associated with those draws. And then other things like subordinate loan policies, which can be important if you're trying to secure gap funding in second position, for example, or default interest, balloon payment penalties, late fees, other punitive costs, just in case something goes sideways. You really want to make sure you're aware of what those associated fees and conditions are. So while you may think you don't need these to be factored into the decision up front, it's important to weigh the costs associated with worst case scenarios, because sometimes this just happen and they're out of our control, right? So we'll be discussing these types of conditions in our next webinar that Nia said that we're going to host a series. So the next one will be about those qualitative factors to take into consideration. Next, we have documentation and underwriting requirements. And those are critical to take into consideration depending on how you qualify as a borrower. You may fit some lenders' credit box and lending guidelines better than others. So it's also always important to address the documentation requirements that are necessary, how long it takes to get underwritten. One key part of documentation that we probably should talk about, and it's addressed in our calculator, is the appraisal and credit checks. This can definitely add to the costs and the time to close. So be sure to address how creditworthy you are. I know with some, they have a credit limitation, in the low 600s, but I've seen also a lot of lenders increasing their credit limitations up to 700 plus. So it's really important to understand what those credit requirements are. And then also to make sure how comfortable you are with the valuation expectations. So using a third-party appraisal, that factor that into your costs as well as your timelines too. Because while a single family may only run you a few $100, if you have a multifamily or a commercial appraisal being done, that can cost you several thousand and take up to a couple of months to complete. And as an example, I did a 5-plex in Wenatchee at the beginning of April, and that appraisal, which took me actually surprisingly only 4 weeks long, but it was still $4,700 to get completed. So those are some things that should definitely be looked into. And then lastly is reputation and market credibility. Those can go a long way, especially right now during COVID. You really want to weigh lenders want to weigh your personal real estate experience, but you also should be asking around within your network who's reliable and who can perform what they say they'll do. Last couple of months, we've had a lot of lenders backing out either midway through the processing stage or right at close. And so it's really important to ask around for referrals and make sure that you know that your lender can perform. So I'm sure there's plenty more factors here that you might want to take into consideration. We're going to cover the ones that affect direct costs. And then again, we'll table the rest to the next webinar that we're going to have. So in very broad terms, we wanted to classify lenders really into 3 generalized types. And I want to say that this is really a broad categorization. Not every lender will fit into all of these. Not all local lenders are going to have low to no doc requirements, but we wanted to just classify them in terms of understanding that there's some basic similarities out there and how they operate, but then also make sure that you understood what your gives and gets will be. So on this slide, you have your spectrum of lenders with a few basic criteria. On one axis, you have cost, and on the other axis, you have underwriting. This is an important distinction because there's trade-offs to manage when you look at loan options. And on the one hand, if you're seeking the lowest rates and terms possible, which I see happening all the time on social platforms, people looking for the cheapest rates out there, you'll probably be working with a national lender, and the underwriting requirements tend to be much more involved than if you were to work with a local lender. Simply just because the local lender is within your market and maybe can do a drive-by, and so you won't have the appraisal costs. And they can meet you in person, so your experience and documentation of your experience is less important. So just starting on the top left, we'd have what we'd classify as our local lenders. My company falls into that category. They tend to have higher rates, but they can also be much quicker to close. Why is that? As I mentioned, they're local, they have the ability to do their own in-house valuations, so they can skip the third-party appraisal process altogether. They're also much more intimately in tune with the local market, making underwriting decisions much quicker than a national lender. Because oftentimes these lenders have either a single office or a few small local offices where sales and underwriting reside, and so decisions could be made much quicker. Examples of these types of lenders would be Eastside Funding, Interest Funding, and again, my company, Flynn Family Lending. In the middle, you have what we've kind of batched together as regional lenders who may only operate in a few markets and may have an office specifically within your market, or in this case in Washington. And they can offer some lower interest rates as well as lower costs, but with a few extra hoops to jump through. So these lenders will ask for more documentation typically, income requirements, bank statements typically, tax returns, and they would probably ask for a third-party valuation. Sometimes that can be either through an appraisal, or some of them will work with a quicker BPO. Third-party draw systems are usually in place. Credit limitations are in place as well. And underwriting decisions sometimes can be made outside of the state that you reside in. Examples of these regional hard money lenders would be Merchants, Civic, and Knees Companies Certain Lending. And then if you look at the lower right-hand corner, you have what we batch into national lenders, who tend to be cheaper, but also have closer to full doc underwriting like you would get through a conventional lender. And that can cost some extra time and money. However, if you're well qualified and you have the right experience, you have the ability and desire to provide all the necessary documentation, or you have an established relationship with that lender, you can get some really great late rates and some lower fees. That said, closing can tend to be a little bit longer than local because of appraisals, and many have limitations that may be a barrier for entry for newbies, or for credit challenged individuals, or investors with little cash reserves. Some examples of those national lenders would be Lending Home, Anchor Loans, and Lima One. Perhaps you've heard of some of those. So before we move on, I wanted to point out that there's the idea of the cheapest lender out there with the least amount of requirements. And we call that, Nii and I like to call that the unicorn zone. That's in the lower left-hand corner. The reason we call that is that, simply put, there's seldomly a lender who would originate a loan for less than 1 point, offer low single-digit interest rates, no cash reserves, no experience necessary, no qualification of your property or project or the borrower. And so often we feel that when a lender offers this type of thing, especially if you have no established relationship with them, you should sort of proceed with caution. This is where some of those Nigerian prince offers come into play and things of that nature. Not all of them are scams, but there's a high degree of fraud or a bait and switch opportunities that when they're offering such such extraneous, like rates that you just, you know, they're hard, too good to believe. So that said, as we mentioned, all of this is really just a rule of thumb and a way of kind of bucketizing some of the lenders and what your traditional trade-offs you are going to have as you sort through the options that are available to you. And so really you just have to do your own due diligence when you're working with potential lenders. I guess I should stop real quick and just see, are there any questions that we need to answer any?
So what is Dutch interest? It's basically, it applies when you have like a rehab loan with a lender, right? So there's two ways to charge that interest. One is that, especially a lot of national lenders, they tend to just charge on the entire loan amount, right? And so no matter how much you borrow, whether or not you've used that money for the rehab, you're going to pay interest on it from end to end, from beginning to end. And then, so that's Dutch. Non-Dutch would be considered charging only what you use. So, you know, when you first borrow money, your total loan amount is maybe $200,000, and if you have a $50,000 rehab, then your initial balance, your initial principal is only $150,000. So you're only getting charged interest on $150,000, right? And then as you take draws, your balance grows and grows, and the interest that you pay is always based on the balance. So the interest that you pay every month starts to grow as well. There's pros and cons. I mean, most people would prefer non-Dutch, right? Only charging paid interest on what you use. But I would say that a lot of lenders who offer, you know, only paying interest what you use also have a harder draw process from what I've seen. So there's trade-offs. I mean, I've also seen people say, hey, you know, we're going to charge 12%, but you only pay what you use. And then is that really better than someone charging 8% on the entire loan amount, right? You just kind of have to calculate it out.
So it'd be a little bit remiss if we just didn't discuss briefly the elephant in the room, and that's the changing landscape of lending due to COVID. If you've done a flip or refinance lately, or trying to close a purchase, or working on a development project, no doubt you have had experience with the volatility of lending right now. And that's not just hard money, that's conventional, commercial, any other alternative financing as well. So it's nice on the one hand to see that rates are dropping to the lowest point in history, but the reality is that while rates have decreased, difficulty in qualifying has increased, and access to capital has diminished greatly. So lack of certainty in rental income, W-2 and self-employment income have all created concerns in the lending industry. And so how does this affect hard money? Well, for starters, some lenders who were reliant on selling their loans after they funded your project are now stuck with loans on their books and capital that they can't free up. We've also seen higher leverage loan products disappear. Cash reserve requirements is something that is being discussed quite a bit, but I think you can touch on some of that is shrinking a little bit. And then there's just overall higher loan costs and credit requirements. So I've heard even on the conventional side that a cash out refinance was going to cost 4 to 6 points for I think it was a national bank actually that quoted it, and a local credit union. And then they were also requiring 6 to 12 months cash reserves, which in my opinion, depending on how much you can take out, on a cash out refinance, it kind of defeats the purpose if you already have 12 months of cash reserves. And the difference was dependent upon your credit score. And then just yesterday, I had a call with a capital market partner named Pier Street. Some of you probably have heard of them, and some of you haven't. But they shut down in early March, and just shortly after, they laid off 70% of their staff. Their company was used to table funding and buying loans from lenders across the country. And then just this month, they started back up their operations on a very thin skeleton crew. But they did start back up, but they're only purchasing loans now. They're no longer table funding. So the changes that they were telling us about yesterday is that they're only accepting borrowers with a credit score of 700 or greater. And on their bridge loan program, which is a 12-month product, you need a experience with minimum 5 similar deals completed. And when the LTV used to be 75 to 80% loan to value pre-COVID, it's now dropped down to 70% for a purchase and only 55% for a cash out refinance. They have a minimum guarantor liquidity of 3 months of interest, tax, and insurance, and prepaid interest of 6 months of reserves was required. So this is one example of what's taken place since COVID and how that has impacted lending across the board. So lenders are definitely coming back recently, but they're coming back differently. And this really means that we need to treat each lender as if they're sort of new to the game. Anything you want to add here, Nghi?
Yeah, I can give some kind of like a data perspective too. So, as Beth mentioned, pre-COVID, hard money was pretty widely available. Like you can get it easily anywhere, right? And it was like a race to the bottom in terms of rates. So you had national lenders giving out commonly interest rates in the 7s and 8s at like 1 to 2 points, 1-year loans, up to 90% loan to cost, 75% of ARV for experienced investors in like core markets, right? And then for newer or smaller loan amounts and newer investors, competitive meant terms like 9-11% interest and 2 to 4 points. But between mid-March and the end of May, that standard became 10 to 12%, 2 to 4 points, 80% loan to cost, up to like 65 to 70% of ARV. But that wasn't the biggest problem, right? The biggest problem was like you couldn't figure out who was still lending. And so I pulled public records data and I saw that over half of the lenders that were regularly lending, like throughout the entire decade, just stopped doing loans cold in April and May. Like there were huge lenders that did 300 plus loans per month that did 0 in the last 2 months, or April and May, right? And you would think that this would be an opportunity for the remaining lenders to kind of pick up the market share, right? Especially those who were, the small local ones who didn't need to resell their loans in the secondary market, right? And from what I saw though, it was like the vast majority of lenders that were still lending also had reduced loan volume in April and May. So, and when I say heavy reduced, looking at Washington State, right? The total number of loans funded in April was a third of the average monthly volume in Q1 of this year. So in May, that was in April. May is looking more like 20, 25%. And was this because there were less deals, right? We saw that, obviously inventory went down a little bit, but went down to 20%. That didn't make sense, right? So deal flow explained some of it, but the big majority was because lending simply got harder, right? Lenders became more strict in their criteria. They required more down payment, more reserves, higher credit scores, as Beth mentioned. And then you have other types of loans like construction lending and long-term asset-based rental loans. Those just simply died. And so commercial loans got hit pretty hard too, which if you hear people complain, it killed a lot of their big deals and people got pretty upset about that. And then it's funny because commercial banks started focusing more on PPP loans because those actually made them more money than real estate loans. So they put real estate loans on hold further because of that. But the nice thing is that, so this month, as Beth mentioned, they're starting to come back into it. So lenders are coming back, products are coming back, and the rates are slightly dropping and the LTVs are slightly rising. But the terms that we're seeing are still pretty far from pre-COVID. And I don't have a good timeline for you on when we'll see those rates again. I'm thinking 3 to 6 months out, maybe 12 months. It's just, we're completely dependent on the capital markets to get the cheaper pricing, and they're not recovering fast enough right now. We have one additional question. Okay, why is it sometimes that, we got a loan for 150 but we get our payoff and it's for like 156, even though we're paying points and interest rates? One reason is because, when your payoff includes sometimes almost 2 months of interest, especially if it's like, if they haven't received your payment for this month yet. Sometimes they have high fees on the payoff, which is rare. But I would say if you're seeing like a $6,000 or more, probably because the lender probably rolled in the points and fees. So there are lenders that, they make you pay everything up front. And there are lenders that, don't worry about it, we'll put it into the loan and then you'll pay off at the end. I think it's a good time to head to the calculator then. I would say the best way to use this calculator is if you're getting term sheets from lenders, right? Like let's say you're talking to different lenders and you're getting kind of offers from them. So once you get that, you start putting into here, because the most of the inputs you need to put in are on that term sheet. And unlike the conventional world, a term sheet in the hard money world, there is no standard format. So you could get it, over PDF, over email body text, and then over the phone, just anything, right? A lender can give you terms anyway, and there's no rule they have to kind of follow for that. I would say you don't need a term sheet to use this though, because if you already know the details from the lenders, already talked to them about it, and you already know what to put in, you should be good to go. The nice thing about the calculator that we really want to emphasize is that it kind of reminds you to ask certain things of lenders, right? Like, oh, did you ask about the appraisal fee? Did you ask about draw fees and extension fees? Going over this document should be simple. So the calculator itself, the colorful part here is right in the middle. On the left-hand side, you have the instructions. On the right-hand side, you have kind of like tips and additional things that you might want to know about. So going from the top, we made the calculator somewhat foolproof in a way. So you can't, like, places that you aren't supposed to touch or that breaks things, you're not allowed to actually click on, right? So all the calculations are there. It's really only the inputs that you can put something in. So we'll go line by line. This is meant to compare not necessarily different lenders, but also different loans, right? So sometimes you might get different loan options from different lenders. Like you might have one with higher down payment, one with lower down payment. You can put that in here. You can say, hey, lender one, my keyboard's loud, I apologize. Lender two, let's say you put 8% loan cost, right? So think of it that way, right? It's not just by lender. The second line loan amount, it's rare that you'll get the same loan amount offer from every lender, because every lender makes you put in different down payment, right? And so just keep that in mind. And sometimes you might pay more for a loan just because everything is based on the loan amount, right? So if you really want to compare apples to apples, put in the same loan amount, but realistically, you'll probably have a different loan amount for every lender. The loan term, so this is basically how long of a loan they're giving you, right? In Washington State, you're going to see between 5 and 12 most commonly. Putting it in here and putting the right term in here is important, because later on at the bottom you'll start seeing, like, okay, what happens when you go past that term? And then points. So points they're called origination fees. They're basically a flat fee that you pay on the loan, and it's typically paid up front, but sometimes you can also pay at the end, but that's pretty rare. And it's usually a percentage, right? So there are times when a lender will say, well, my origination is just $2,000. And a couple ways you can do that. You can just calculate what percent $2,000 is from the loan amount, or you can just, like, I don't know, put down here. So like put 0% and just put $2,000 down here, right? They both have the same result. And then interest rate, pretty self-explanatory. Going back to the idea of Dutch interest, and we'll talk a little bit more down here. But so we assume, and we stay conservative, we assume that you're paying the same payment and on the entire loan amount the entire time. If you happen to get a non-Dutch loan, which means that you're only paying on what you borrow, you're going to save a little bit, but in the long run, most people don't save that much from this, unless it's like a construction loan, right? Because in construction loan, sometimes your renovation, if your rehab is bigger than your acquisition loan, then yeah, you're going to pay a lot more interest in the Dutch scenario. But most construction loans, you pay as you spend, so you don't have to worry about that too much. And then fees. So this is where someone was asking, what kind of fees do we get from each lender? There are a whole bunch of fees that you can get charged. Typically, lenders only charge one or two fees, like a processing fee or an admin fee or a doc fee, underwriting fee. But if you start going out of state, you're just going to start seeing a legal fee, an attorney fee, and sometimes you see both of those. I'm like, what is the difference, right? You have to ask those questions, like, what is each fee for? What am I paying? And recognize that sometimes lenders put things on there that might be third-party fees that are not necessarily their fees too. So this bucket is meant for fees that the lender is directly charging you. Going to the next one, we have broker fees. So if you went through a broker who shops multiple lenders for you, they typically tack on their own fee. The difference between a broker fee and a referral fee is that a referral, and then you contact the lender and say, hey, I referred someone to you. Can you just pay me $500, right? Or however typically the referral fee is. A broker is someone who's much more involved. They typically take your application, they vet as much as they can on the lender's underwriting criteria that they know of, and then they'll send a loan over. So it's kind of like they do a lot of the pre-underwriting for the lender. As Beth mentioned, going through a broker can be more expensive, and a lot of times they add their fee in terms of points, not flat fees. But I just say just calculate it, right? Like for this one, I'm calculating a 1% fee, right, which is $2,500. Going through a broker doesn't always mean it's going to be more expensive. Sometimes brokers can negotiate wholesale pricing or discounts with a lender, right? Because a broker can bring volume to a lender, so they can get that. And sometimes it also depends how much the brokers charge. If the brokers charge a lot, like if a broker starts charging more than 1 or 2 points, it probably is going to be more expensive going through a broker than directly to a lender, right? But some brokers, they don't take that much. So it just kind of depends who you're using. Okay, so valuation fee. This is basically the appraisal or the BPO or even the desktop valuation. Sometimes you might get charged a fee for that, right? Even though they don't send anyone out. And I just listed that in order of how most expensive to least expensive. So appraisal is going to cost the most. BPO is probably going to cost like $200, $300. And then desktop valuation, I don't know, up to 300 I've seen. It also depends on the area you're in too. I mean, on the West Coast, I mean, appraisals, it's normal to see 700, 800 plus. If you're in another state, I've heard that it's like, even for conventional loans, it's like, oh yeah, I pay like 400, 500 bucks for an appraisal. A lot of times lenders will give you a term sheet that says, okay, here's your terms plus appraisal. So it's kind of like you have to estimate the appraisal. You can ask the lender, can you just give me an estimate of what that will cost? And sometimes the lenders, it's not their fee, right? So they can't give you an exact cost sometimes until you actually get into further in the loan. But I would say, hey, if it's a single family house, 800 bucks is a good conservative estimate. Or if you need to rush it, maybe like $1,000, right? So yeah, I mean, but ask your lender for guidance because it depends on who they're using for these fees. Other loan fees. This is kind of like any other miscellaneous fees that a lender would charge or that come from somewhere. I would not add things like closing costs, title insurance costs here because one, it's not a lender fee, right? It's not the cost of getting a loan. Whether you're paying cash or you're going through financing for a property, you're going to pay those fees regardless, right? So it's kind of independent across all the lenders. So if you're going to put it in here, you might as well put it in all of these if you really want to compare the lenders accurately. So just recognize that not everything you see on a term sheet belongs to a lender. So these are all the fees that you usually incur upfront, right? There are these fees that you kind of incur during the life of the loan. Draw fees. So if you're doing a rehab loan where you're borrowing money for renovations, a draw fee is basically every time you request a draw and they have to do certain things, like they had to process it, they had to send out an inspection, they might have to order like a title check to make sure you don't have any additional liens on the property, and they might even charge you a wire fee, right? So all those kind of add up. I would say it's normal to see 100 to 200 bucks per draw. To actually put this box in correctly, so ask the lender, what's your fee per draw, right? And then estimate how many draws you plan on taking. So if you wanted to borrow $50,000 and you wanted to break into $10,000 chunks, that's 5 draws. I know someone who needs a loan. Hey, go check out this lender. If the lender is charging 200 bucks per draw, that's $1,000. So you put $1,000 in here. Some lenders, they charge draws up front. Let's say I'm going to charge you $1,000. It's going to include however many draws, and you'll pay that up front. So you could include it up here, right? But just don't double count it. The other thing too is extensions. So this is really important because most people, investors are very, very optimistic. They don't think anything's going to go wrong with their property. I have a 5-month loan, but it's okay. I'm going to sell in 3 months, right? I would say just always, no matter what, plan for the worst case and find out what exactly that means. Ask a lender, like, how much did you charge for extensions? And extensions can be weird. They might charge you a default rate. And so you have to calculate what does that mean per month? But usually, like a local lender said, here we'll do 1 point for 45 days, right? Or 1 point for 3 months, or 1 point for 2 months, or 6 months, or something. Just calculate how much that cost is per month. So if it's 1 point for 45 days, to make it easy, then it's basically 2 points for every 3 months, right? And so you would pay basically 0.66, 2/3 of a point per month, right? And you just times that by the loan amount. So that's how much it would cost per month. And so taking all these into account, right? So after you put all these in, then you can see, okay, how much am I paying per month? And your lender will usually tell you this too, but you should confirm it. Interest payments are your variable costs, right? You incur more as you take longer in your project. The fixed fees are usually fees you pay up front, or it might be some like a draw fee as well. No matter how long you hold it, you kind of pay the same, right? It's usually most of these costs. And so you add them together and then you annualize it. And there's if you want to know what the calculation is, you just kind of go on the right-hand side and it breaks everything down. And this is kind of like, if I were to use this lender, kind of like annualize across a year, then this is kind of how you compare lender side, apples to apples. And then the cool thing is down here, like how long are you expecting to hold it? We basically say, okay, I'm assuming most projects will finish within 12 months. you can just find the line item that reflects how long you plan to hold it. So 6 months, and here's what every lender will cost at 6 months. If you have a loan that it's only 10 months, and what happens after 10 months? Well, if you didn't put an extension fee, you're not going to see anything after 10 months. We assume that, okay, there's no way to go past 10 months because we don't know how to extend it. For loans that do have an extension fee and less than 12 months, you'll see them in red. So all the reds are basically, hey, you're paying much more cost now to hold it because you've gone past the time of the loan. And so again, this is a nice way to compare loans side by side. There are times when you can get a 6-month loan and extensions are still cheaper than another loan, right? And so there's loans where, hey, yeah, it might be cheaper up front, but then over time, it's kind of like, oh, where's the break-even point where they start equalizing? So if I'm planning to hold this loan for more than 9 months, I should probably take lender 3 versus lender 2. This is a loan where, a lender says, I'm only going to charge you 1 point, but my rate is going to be 16%, which basically means that it's going to be pretty cheap in the beginning, and then it's just going to cost so much. So you can see like the break-even between these two loans is probably around like 3 months, right? So if you have a quick flip, let's say, hotel, you don't really need to fix it up, just clean it up, put it in the market after a month, then yeah, this is probably a good loan for you. But, I would say be safe, plan for 12 months for everything, and then just see how much that's going to cost you.
I think it's important to let people know that as we were discussing the best and most simple way to be able to just calculate, those quantitative direct costs, there's so much more involved here, right? But we wanted to scale it back and make it as simple as possible. But we could add in so many more different types of fees or costs or things in there that would just kind of blow it up. And we really wanted to keep it simple. Someone asked, what are some of the things that a borrower should not do, things that reduce the probability to get a hard money loan? First thing that comes to mind to me is lie. And while I think that seems pretty straightforward, I've got a lot of people who've called us and tried to seek out loans, and maybe they weren't necessarily lying, but they weren't really providing full disclosure that maybe if they were going to put a property up for collateral, that they had a personal judgment or an IRS lien and title wasn't clear. Or they proceed, with the idea that they've got a lot of cash reserves, and when asked for proof, though we don't ask for quite, a lot of that, they don't really have the funds available to close. And so being really honest with yourself and with the lenders that you're having conversations with about your scenario can help you get farther across the finish line. Do you have anything to add, me?
When you get a quote from a lender, hey, assuming everything that you say is true, this is what we can give you. And then when you actually get into underwriting, that's when they verify that everything you tell them is true. If they sense dishonesty, you're not getting that loan. Obviously, things like credit scores, a lot of lenders care about that. That kills loan pretty fast. Criminal history.
Understanding your project. I mean, when you give us a pro forma, that was created by a wholesaler or another outfit, and you can't explain the numbers or you haven't really vetted them out yourself, that can tend to make us feel like maybe you haven't necessarily done your personal homework, and that you're relying upon other people to not only bring the deal to you, but also vet it out. And so that gives us a little bit of concern about how effective you are to get a project across the finish line.
I think our next session will go more in depth on that too. That's more like the qualitative stuff.
Absolutely.
So Nikki asked, she wants to see the ability to add like financed, basically rolling points and fees into the calculator. I would say, we kind of built this because we wanted to make it extremely easy to use. So it covers at least 90% of the cases. It's meant for simple, not really power users. We might release a version 2 that's meant for like someone who really knows what they're doing and plugging advanced things that covers more corner cases. The calculator calculates loan cost, right? So when you are rolling in things like points and fees, it's a very small percentage of the loan. So it doesn't really change your cost too much. When you roll in points and fees, you're paying interest on the points and fees. And I hope people realize that too. We've seen a lot of troubled loans because fees and points were rolled into. Like, let's say you got a high leverage loan at 90% and it got even higher to like 93% because you finance everything in. If you get in trouble with that loan and you try to refinance, lenders are not going to want to take that because it's so highly leveraged. So keep that in mind as well. I mean, most people want to minimize their down payment and minimize their cash out of pocket, but it comes at a risk, and you usually pay more for that too. Spore asks, how long does it usually take to get a proof of funds letter? I would say within 24 hours is pretty reasonable.
Well, the next session, we were hoping to put together a detailed questionnaire or like a lender interview guide to help you uncover the qualitative aspects of lender that we need to figure out. So there's just a lot of detail to cover that's not necessarily numbers related. As Nhi said, just as a real basic example, construction draw costs is just one element that you can factor into the calculator, but understanding what the construction draw requirements are is a whole, another set of questions to ask. Some lenders will just do it based on pictures or a drive-by, and those are mostly your local lenders. Others will work with a third-party construction draw company, and they'll either require you to provide invoices, or maybe they'll require you to provide receipts. So you have to pay for it first, and then they'll pay you back. Those are the types of questions that we want to tease out in a lender interview guide that hopefully we'll put together, and I don't know, in the next week or two, and then have another call with you guys about. And then again, as I mentioned, if you guys have some suggestions for other topics related to real estate financing, go ahead and throw it in the chat here, and then we'll just catalog those. And we're going to have quite a few other calls. One of them was going to be, maybe like about the top 10 mistakes that borrowers make when trying to seek financing. So that was kind of mentioned in the comments as well. We also wanted to talk about what are the underwriting requirements that lenders look at when qualifying borrowers and loans. So there's quite a few different topics we can cover. So if you have anything that you want us to address specifically, go ahead and throw it in the chat. I think that's it. Thanks, everyone.